Okay, I'll just check you guys in here, all right? So, yeah. Okay, is there any sound over there? No, it's not much sound. Okay, is that any better? Not more. Okay, how's that? Is that better? Is that better? That's okay. What about you guys? You're okay? And you're okay? All right, put you guys in the middle. Okay. Okay, so let's make a start. Let's just review briefly what we did last time. So we're in the section on derivatives, and derivatives are a class of securities, a range of different types. But their common feature is that the value of a derivative depends in a very clear way on the value of some other asset, and that other asset is called the underlying asset. Sometimes it's simply referred to as the underlying. And so that's the general description, and we're looking at a range of derivatives in this course, and currently we're in the section on the forwards and the futures. So we looked at briefly three markets: the spot market, and spot market is where if you want to trade the asset, you simply trade it today for delivery now. For example, if you bought an electronic copy of the textbook from the publisher in Australia, when you did that transaction, the foreign exchange transaction would have been carried out in a spot market. Both the forwards and the futures markets, what you do in both of them is that you agree on a price today for the delivery of the asset in the future. So it's set in both cases that you make that decision today, what the price will be, and then some future time there will occur delivery. But what makes the forward and the future different is the forward is a dealer market, and if you want to take out a forward for some reason, then you talk directly to a dealer, and pretty much every aspect of the contract that you enter into with the dealer can be customized to suit whatever needs you have. Now the futures, which have a very similar purpose, and contracting for a price today for delivery in the future, is traded on an exchange. And on exchanges, it is the exchange itself which sets the terms of the contract. So they specify exactly all the terms and conditions of the contract. Everything is standardized, and that makes these things very liquid in terms of being able to trade them. Now, because of this difference between them, one is very customizable, one is standardized, we find that the actual two markets are used for quite different purposes. The futures market, because it's so liquid, you can get in and out easily. You often see a lot of speculation there. And in the end, most of the contracts end up with no delivery. People close out their contracts before the expiry, and there's no delivery at the end because the contract is closed out. And typically, well above 90% of contracts are closed out before the end and do not result in a delivery at the end. In the forward market, because everything is customizable, if you have a genuine need to hedge, that's where people tend to go. And so what happens in those ones is typically well over 90% end up going the full term and resulting in a delivery at the end. So in one sense, they're quite similar in terms of what they do, but how they are used is quite different. So that brings us essentially to this point here about how on earth do you get out of your position if you're in a futures market. If you're in a forward market, you actually have to go back to the dealer and ask to close your position out. But if you're in a futures market, you simply go back to the market and trade. So if you have a long position, because there's two sides to it, if you have a long position, you simply take a short position in the same contract. And that closes your position out. Similarly, if you have a short position, you take a long position and that closes out your contract. Now we can sort of understand what that does in terms of the price risk and stuff. So let's just very quickly draw a diagram. If you think about what's happening, let's say here it is, and there's the initial price, there's the long position there, and let's say things moved up in your favor, and the price is over here, and you think, I've done pretty well, I'll close my position out, and I'll take my money. So to close out, all you got to do is take a short position. So see how this is the price today. you take a short position like that, which will run through there like that. And of course, the sum of these two things, from now on, your price risk is zero. So there's your price risk there after you've closed position. So in some ways, it sounds quite strange that if you have a long, you take a short. If you have a short, you take a long. The other thing that you might think you can do is actually sell it. If you have long, you might go actually sell the long, but you don't. You take a short. So why would they do it this way? Why would they just say, okay, if you don't want your long anymore, go and enter into a contract for a short? What's the advantage of doing that one? Then the alternative, which would be to take your long and sell it. What's the advantage of taking a short over selling your long? What's that? Transformation. Can you elaborate? Okay. No, that's not the reason for it. Okay. So that's not why they do it this way. Anyone else? What's that? Is it faster? Well, it depends on the market. It might be faster. It could be faster. The main reason they do it this way is if you think about taking a short versus selling a long, when you think about, go back to the start, how they get started, they're started in pairs. So when the trade goes ahead, there's no contract, suddenly there's a long-short position pair. And then if you want to get out of your side of it, you simply take the other position. And what it saves you having to do is actually have two markets, okay? So instead of having to know whether you already have to have a position that you want to close out, you simply use exactly the same market, okay? Because if you think there would have to be one market for opening positions, and then a second market where if you had a position that you would sell on to close out. By simply taking the opposite of what you have a long, you take a short. You have a short, take a long. You can simply carry on the whole thing on a single market. You don't need two. Whereas if you were selling a long or selling a short on a market, you would actually need a separate market because you would need to know whether somebody was opening a position, had nothing, or whether they had one that was selling and closing out. So this allows them to do it on a single market. Okay. Any questions on that? Okay. So this is an example of a very short form of the contract. There's much more detailed contract on this is a corn contract. I probably can't read that very well, but this basically tells you all the details about it. So the contract size is 5,000 bushels, in which this case is 127 metric tons. And tells about the grades. This doesn't mean anything to me, I'm not a corn guy. But number 2 yellow is the contract price, and then you can substitute either number 1 or number 3 and have a price change. Tells you how it's priced, tells you the minimum size in terms of price changes. In this case, it's 1/4 cent per bushel is the minimum price saved. The contract months, March, May, July, September, and December. So there's actually 5 months that these contracts will settle on. It gives you all the details about price limit and stuff. And this one's actually a physical delivery. So if you wait until the end and the contract expires, say you had what's the next one up, probably the May one. If you had a May contract, you come to May and it expired, and you were on the long position, then you would take delivery of this 127 metric tons of corn. Now, there are stories about unfortunate traders who had 127 metric tons of corn dumped on their front lawn because they forgot to close out their position. Now, those are nice stories, but they're not actually true, because this bit here is from the longer bit of the contract that tells you about the delivery. So it tells about delivery report. It says corn shipping certificate can specify shipment to one of the warehouses. currently regulated for delivery, located in one of the 4 territories. There's actually only 4 delivery points, and they're the big grain trading centers where there's great monstrous silos full of corn. And so that's where your corn is going to be delivered. And so if you were a trader and you forgot to close your position out, that's where the corn would be. They wouldn't dump it on your front lawn. And then, of course, you probably have to sell it on the spot market. But if you were a genuine hedger and you were buying that corn, then you would have to arrange for transport from one of these silos to whatever processing facility you have. And so that's how the physical delivery is made in this case. There are simply 4 physical places where the delivery takes place, and then it's up to you to then transport it to wherever you need it. And so all the other details are there about the futures. Okay, any question on that before we go on to the margin accounts? Okay, so now we're going to deal with the margin accounts, because remember yesterday when we were talking about these things, if you go to a forwards market, you actually talk to the dealer at the other end to get your forward set up. So both you and the dealer can assess the probability of default on the other side. So if you ring up the ANZ, you enter in a forward contract for, say, foreign exchange, you can actually assess what the default risk there is. When you're in a futures market, you don't know who you traded with, and so you don't know what the default risk is there, and that's why we go to this process we call novation, which puts the clearinghouse in the middle. And so 2 traders don't have to know who each other are. They don't know each other are, and so they put the clearinghouse in the middle. But of course, this leaves the clearinghouse with a problem that it has a default risk on both sides. So what is the purpose of having a margin account? Very nice. Or payment. Okay. Yeah, in one sense, yeah. Yeah, yeah. Okay, so it's basically a clearinghouse way of dealing with default risk. Yeah. So that's what these things are for. The default risk is quite real on both sides because it's got both ends of the contract. It has default risk both sides, and the purpose of the margin account is to deal with that risk. So let's figure out how one of these things work. So we'll start drawing a picture here of what actually takes place in one of these things. So let's start here. So here's our basic position. So this is the price of some asset. Doesn't really matter what it is. This is the dollars up here. Showing up. Yep. So if you want to open a position, there is a specified minimum amount of money you have to stick in this account before you can actually even trade on the market. And that's what we call the initial margin. So the initial margin is what you have to deposit to actually open your position. And so there will be a specified amount of money that you need to put in per contract before you can actually even trade on the market. So we'll shove that up here. So there's a line across there. That's the initial margin. And any trader who wants to open a position of either long or short pipe has to deposit the initial margin. Now, as the thing goes along, unlike the forward, which basically once you have your initial setup, maybe there's a fee associated with that because you're dealing with a bank, there's usually no cash flows between then and maturity, and at maturity there's delivery and you pay. Now, with the futures market, they actually go and they basically look at your value every day and then make adjustments to your balance every day. And so there are essentially a cash flow every single day that this market is open. And if you get down too low, and we'll come to exactly how this happens, if you're on the wrong side of things and your balance gets down too low, they say put more money in, and that thing, when I say put more money in, that's what they call a margin call. And they usually do it once a day, but if the market gets really, really really volatile, they have the ability to do this more than once a day. So if the market really starts to get volatile, they can require you to put more money in more than once a day. So what we'll do, we'll look at this example here. So here's the numbers over here, and there's what's going on. So what happens is that today's price in this market is at 3,500. This is the stock market index on the this is on the Australian exchange. ASX 200 index. And so both traders put in this case, this thing says there they've got to put in $2,500. So they both got to put that in. So we'll just do this on, like they're both there. And there's this other thing which is the maintenance margin, which is here. And that's, in this case, 75% of the initial margin. And if you drop below that in terms of what's in your account, that's when you're going to get that margin call. So there's another line down here. So this is the maintenance margin. And in this case, it's $1,875. Okay. So when they open their position, so exchange is there, two traders, they get matched. There's this long-short position is open, long-short pair, and then it's shoved over to the clearinghouse. And so, again, that's priced in such a way that it's worth zero. So the initial position, worth zero for both traders, plus their margin of 2,500, puts them both at this point. And so the long position will look, long is up there, and we'll put the other guy down here in terms of, there's the short position as the price moves. Okay, so that's how they get started off. They have an initial value, 2,500, which consists of 2,500 in the margin account, plus a contract which has zero value right now. Okay, so that's our top line in each of those charts there. Okay, after one day's trade, the price changes and it goes up a bit. So now the index, so this was day zero when you started, gone up to 35.20, and this is day one. So if you see what happens here, so put a line through here. If we take the short position first, what's happened to the person with the short position? They lost money. And in this case, how much did they lose? How much did they lose? $500. So they lost $500, so that gets taken out of their margin account, and that simply gets transferred over to the other guy with the long position, and they have a gain of $500. So at this point here, this person is down to 2,000 on their short position one, and the long guy, or girl's case would be, is up to 3,000. Does either of these people get a margin call at this point? Get a margin call? Okay, the way to tell is if the value in either account drops below the maintenance margin, they get a margin call. In this case, although they've lost $500, they're down at 2,000. That's above the 1875 maintenance level. No margin call in this case. So that's fine for day one trading. Okay, so the next day goes along, so we get another day, and again, market heads up, and this time it goes up to 35.60, and this is day 2 at the end of close, so market's closed now, and the clearinghouse does its thing. So in this case, what's happened to the person with a short position? What, have they made a gain or a loss? Gain or loss if you're in a short position? More loss. Oh boy, more loss. Okay, so in this case, they've actually lost of $1,000. Okay, so they're down there. That gets transferred over to a long position. It goes up there, and so they have a gain of $1,000. And so what happens is this guy here on the short side is down to $1,000, whereas the person on the long side is now up to $4,000 on their account. Okay. Now, does either of these people get a margin call at this point? Yeah, the short one's going to get a margin call. They have $1,000 in their account at the end of the day. They're below the 1875 maintenance margin level, so they get a margin call. So the question is, how much money will, when they get a margin call from the clearinghouse, how much money do they have to stick into their own account? So you think it's got to come up to here? Okay. Anybody else think that they need to go up there? In actual fact, you do have to go back to the initial margin. You have to go all the way back up here, so you get a margin call. And in this case, you have to put in 1,500, and that's just the minimum. No problem putting in more if you want, but that's the bare minimum you put in. So let's think about how on earth does the clearinghouse figure out where to set the initial margin? How would you work out where to put that? And they've set it 2,500 an example. But in general, how would you work out what the appropriate amount of money that you're going to require if you were to put in to just open the position? Depends on initial price. Yeah, it does. Anything else? Any other key ingredient in there? Okay. Yeah, it's either it's really they're concerned more about not really concerned about you gaining money. They're concerned about you losing money, and it's the maximum one-day loss. So basically, what they've done in terms of setting the initial margin is that they've looked at the data and say, what is the maximum one-day loss that a trader could be expected to sustain? And so that's the basic question they ask themselves when they set the margin. And when you think about the purpose of it is to prevent themselves from having a problem with default. Basically, what they've done is they set up in such a way that if there's a real terrible day on the market, neither trader will actually go into negative value. Basically, even if you get a big drop, say it's, well, in this case, say it was a long position, and there was a big drop in the market, they wouldn't go negative on a single day's price movements. And that's how we set these things. So basically, in terms of protecting themselves against the default risk, what they've done is set that margin at such a point that a trader will not be wiped out on a single day. second thing they've done to protect themselves, if you drop below this margin here, this maintenance margin, then they say put more money in, i.e. margin call. And you usually have a comparatively short amount of time to respond to that. Typically, it's only a matter of a few hours, because once the market's closed for the day and there's no more trading, then you're not going to lose any more money that day, but they want that money in there fairly quickly, so that basically they get their protection back, and that's what the margin call is about. What if they say, margin call, and you say, no thank you? What happens? What if you don't pay? What's that? Well, actually, I mean, the actual market trading goes ahead, but what will happen to this poor little individual trader is that the clearinghouse has the ability to bump them to the top of the queue, and so seeing how they got a short position, so the short position is there, they're going to have to close out by taking long. They'll bump you in the very next trade will be closing out this guy. Okay? Okay, so you're thinking of trying to protect against default risk. This guy's getting down in the danger area, refuses to pay, close him out, and you're protected. And so that's protected you as the clearinghouse against default. So if he's basically saying no more money, he's in the danger area, you just shut him out. Bump him up to the top of the queue, close his position, and then he's stuck. So the margin account, in terms of protecting the clearinghouse against default risk, works quite well. And once you see how it works, you can see why, in terms of setting that initial margin, where that maintenance margin is, how the margin call works, and if you don't respond to the margin call, the ability to close them out, the ability to do this more than once per day if necessary, it all is there to protect the clearinghouse against a default. Because, you know, often they really don't know who these people are either. In terms of, it's not like ringing up someone in the forward market and actually talking to them on the phone. You know, these are people trading sometimes, trading through brokers and stuff, and the risk is simply unknown in many cases. Anyway, there is one more line in there. If it went back down here, so in that case, there would be a small loss on the long position, and that would be, I've left one line out. Okay, so the margin call is here, okay? So what's happened now is this line here has actually shifted over. So assuming they make the margin call as required, this is now the short position after margin call. So it simply shoves them over there. And if they put the more money in, then they can simply keep going. And in the next one, we have the small drop, and that would then give them the money. Okay. Actually, sorry. Shouldn't be there. Should be here. Sorry. Do it in the wrong place. Yeah, because it goes up there. Anyway. Still same thing. Short position after the margin call. Okay. Any question on this before we move on? Yeah. Yeah. Maintenance margin. I mean, what they have that for is that you can sustain small losses without being subject to margin calls. So, like, if the thing sort of traded around and you stayed in here, it's just there to stop little margin calls all the time. And they are. When I say that the initial margin is big enough to protect more than any one given fall. The maintenance margin is some, I can't remember what, I think it's like a 95% probability that if you're there, you won't get wiped out as well. So there is a little bit of risk there. But if the market really starts getting crazy, they can do this more than once a day. Every futures market will have its own defined margin in terms of initial margin and maintenance margin. I mean, these are just examples. I mean, they may be, 90%. Yeah, they're at liberty to change that as necessary. And of course, if the market does get quite volatile, they can do this more than once a day. So if things really get bad, usually it's bad when it's going down, then they can call in more than once per day if necessary. Okay, any other questions? Okay. So there is a type of risk, the margin risk, and that's the risk of losing a hedge if your margin calls cannot be satisfied and they close you out. And it's simply a type of liquidity risk. And if you think back to those, those big losses we saw yesterday, two of them, the long-term capital management and the Orange County, got hit by this problem. Okay, long-term capital management, they actually held positions if they were able to hold those positions through to maturity, they would have been profitable, but they got hit with margin calls that they could not meet. They got closed out at loss, and down they went. And exactly the same thing happened in the Orange County case, is that if the Orange County had been able to hold its positions through to maturity, they had profitable positions, they got hit with margin calls, they got closed out, and they had substantial losses, over $1 billion worth of losses. So this risk of losing your margin is quite real and accounts for a couple of the very largest losses in history. So, not to be underestimated, this one. Okay. What's leverage when we're talking about the futures market? What's leverage? Nobody knows. Okay, so the basic idea is that you can take out the price risk on a large amount of underlying asset for a comparatively small amount of money. In the example that we just had, that index was at 3,500, $25 per point. That means that when you opened that position, you had exposure to $87,500 worth of equities on that particular market, but you only had to front up with $2,500 to do that. Okay. So we got a leverage here of over 30 to 1. So what will happen is that the gains and losses on the main market, in this case this is the ASX 200, will be amplified by a factor of more than 30 in this case. So in this case, so an increase in the price of the contract by 100 points, which is only 2.86%, will give you a profit of 2,500, which is what you put in, and so that gives you 100% profit. So you basically amplify the gains and losses of the underlying asset. And this one, 2.86% rise in the market, if you're on the long position, will give you 100% return on your investment. And, if you get it right, you can make money real fast. If you get it wrong, you can lose it just as fast. Okay? So high risk stuff here. Another question? Okay, any question on that before we go on to the using them? Yeah? Oh. No, actually, well, in one sense, it's a little bit like a bank. I mean, they do pay interest on these margin accounts, but they're less than what they get because they basically will take that money and put it into risk-free investments like Treasury securities. And so they earn a little bit of money on that difference. And the other thing about them is that the clearinghouse and exchange are basically one company, and so the more trading goes on the exchange, then that's really where they make the money on the trades. But they do make a little bit on that margin and the interest as well. Okay, so for using them, what's the difference between hedging and speculating? Should be a fairly straightforward question. Okay. Okay, so it's not quite as simple as that. It's because there's two, like in terms of hedging, you have one of two sides. Say you're a producer, okay, then you would want to hedge your sale price. If you're a consumer of a particular item, you want to hedge your buy price. So you can hedge either way, short or long. But the idea in hedging is that you're using these markets to reduce your price risk. If you're selling it, reduce your price risk there. If you're a buyer, you reduce your price risk. Whereas what speculators do is that they take on the risk, they take on the price risk, deliberately take on the price risk for gain. At least they hope they're gain. It ought to be right in either direction. So there's this other group here, the traders. Sometimes what they're really trading on there is that sometimes liquidity goes up and down in these markets, and these bid-ask spreads widen out and narrow. And what they're actually really doing is they're buying liquidity when it's cheap, and they're selling liquidity when it's more expensive. And so they typically start the day with no position, and they end the day with no position, and they buy and sell liquidity throughout the day. The other ones will just explain it there. So this is where there's two types of hedges. The short hedge is when the hedger already owns or expects to own the asset and expects to sell it. So a producer of some sort, we talk about the wheat farmers, they naturally will take a short hedge because they're growing the wheat. In the end, they want to sell it. And so if they're going to hedge, they would take a short hedge. On the other side, there are natural buyers of these things. And so in terms of wheat, might be selling it to a flour mill. And so their way to hedge is to take the long position because they will buy the asset at the end. So something like a producer, they will have the asset when the contract comes to the end. They are natural short hedgers. Those who wish to buy it, they are the people who will take a long hedge. Any question on either of those? Okay. So we'll give an example here. This is an oil future. We'll just show a little bit how this can work. So what we'll have at the end, we'll have a price in the spot market. There's your spot price. And then, so what am I going to call this thing? Hang on. Yeah. So call it receipts, how much you get for it there. And then we'll have the futures market because we're going to have a hedge. And then we'll have a net. So with this thing here, you've got the 15 May contract, and you as a producer think, well, by that time I'm going to have 1 million barrels to sell, and you go off and you enter into a contract with a buyer, typically an oil refinery, but they say, yep, I'll buy your 1 million barrels, and they're going to pay whatever the market price is on that day. So oil refineries can typically put their prices up and down as whenever they want. So they got no incentive to hedge in this particular case. They'll just say, deliver me the oil, I'll just pay you whatever the market is on that day. Great. Now, for the producer, they may well want to hedge this, right, because they've got their costs of production between now and 15th of August. So there's our price today, 109. Actually doesn't make any difference to us because when we enter into the futures price, man, these are old numbers. Oil doesn't cost us much anymore. But anyway, it used to be in the olden days, $108.75 per barrel. That's what your futures price is. So to hedge this, okay, this is an oil producer. What hedge do they take, long or short? To hedge a production. Hedging a production. Are they long hedges or short hedges? Long. Any advances on long? Actually, they're short. Okay. If you're going to sell the asset, you want to short it. A producer will take the short hedge. So they're going to have to take the short position in the market. So the contract size is 1,000 barrels, and so they got to open a position with 1,000 contracts to hedge this. And then, of course, 15th of August, they're going to close it out. So let's take two cases, one when the price goes up and one when the price goes down. So the first one is that it's 107.50 cents per barrel. Because you're selling 1 million barrels, the refinery pays you $107.5 million. At this point, okay, I don't know how long that contract runs for, but anyway, you close it out at that point, and because the price dropped and you're on the short side of things, remember how these drew those lines, if the price goes down, which in this case it did, you're going to gain on the contract, and in this case what you get from your futures when you close your futures out is $1.25 million from closing out your futures, and that ends up with $108.75 million for the sale of the oil. So in this case, price dropped down, you made a gain on your futures contract, and you got the price that you thought you wanted. You wanted $108.75 million, and you got it. If it went up, let's say it goes up. Let's say it goes up $109.50 per barrel. Then when you got paid from the refinery, you get $109.5 million. Now, remember in the short hedge, remember that thing going like that? Okay, price goes up, you lose money. In this case, price did go up, and they're going to take a small loss, not a big one, but 0.75 million there, and that ends up with 108.75 million there. So what they've been able to do is basically fully hedge that production. They entered the contract price is $108.75 per barrel. They got enough of them that independent of whether the price went down or went up, they got $108.75 per barrel when they delivered it. Some of it, in this case, most of it came from a spot market sale. The balance, in the case the price went down, they got a gain out of the futures contract. That brought them up. In the other case, when the price went up, they got more than their 108.75 million out of the spot market, but they took a loss on the futures, ended up at 108.75 million for that oil. And so they completely eliminated their price risk in that case. Okay, any questions on that? Let's go. So there's the other one. Another way, common way that you see them used is stock market trading. If you think about what a fund manager does, if they want to make a major change to their portfolio, many funds, stock market funds, way over $1 billion worth of stocks, and any amount of trading on their part, particularly a large structural change to their portfolio, means that the very fact that they're either buying or selling will drive the prices of those particular stocks up in the case of a buy, down in the case of a sale, and they want to try to avoid that. So what they can do initially is they're going to make a substantial change, is that they use a stock market index to make a change, and remember, for that index, the major index, it's got a beta of 1. So if we think of, like if you think you've got this big portfolio, you think the market's going to fall, and you don't want to take that risk, if you go out and try to sell your stuff, your very fact that you're selling is going to drive the price of your stocks down and going to make your losses, going to magnify the losses simply because you're trading. So instead of going out and selling your stocks, what you can do is say that's where the index is today. So this is our index, and let's say it's at 5,000. And you take a short hedge, and if you're right about the market tanking, okay, you're going to definitely lose money on your stocks because you're still holding them, but you're going to make a big gain in here, extra dollars in here from your hedge. And so the fact that you can hedge this way relatively straightforwardly in a futures market, and you can close out it pretty much any time you want as long as there's enough liquidity there, you don't have to sell out of your stocks to protect yourself against an anticipated market fall. You can do it on the futures market. And so if you're right, the market does tank in the way that you expect, the losses that you sustain on your portfolio can be offset by the gains that you get from a short hedge in the futures market. Any question on that one before we move on? Okay. Might just skip that one. Again, this one is a stock market one. If they want to make these substantial changes, this process can take them several months simply because of the vast size of the portfolios they hold, and the very fact that they trade influences the prices that they're going to trade at. And so what they can do is they can make a change very quickly by opening positions in the futures market. And then, once they've got those positions opened up there, they can actually begin the process of taking structural change to their portfolio. And as they do that, as they sell out of one set of stocks and buy into another, they can simply close out the positions they have in the futures market as they go along. And so that process is used when you're going to make a really big change to your portfolio. The only thing to remember is that your portfolio beta may well be different to 1, and the index beta is 1. And so if you have a beta of, say, 1.2 on your portfolio, then you simply have to multiply the value of your portfolio by 1.2 when you're calculating how many contracts you're going to take. Okay. Another common place is if you're going to borrow money in the future, and you want to hedge that risk with and lock in your price of your funds. So let's quickly draw what's going to happen with this particular one. So if you think about this way, there's a confusing aspect to this here. So we're going to do this on the price, and we're going to say these are treasury bonds, government bonds. So if you have a short hedge, that looks like that. Short hedge, and if you have a long hedge, it looks like this. Okay. What makes it sometimes a little bit confusing is that on this graph, yield is increasing in that direction. And so when we're thinking about hedging an interest rate risk, what we want to do is redraw this thing with the interest rate increasing. So what we do is we think about, because there's an inverse relationship between the yield and the price, and it's a nice curve. That's your long position there, and that's your short position there. So if you expect interest rates to rise, okay, that means it's going to put your cost of funds up. You want to get extra money from the futures to offset the extra cost of the borrowing. So that means you take a short hedge. Okay, so this one here is price. Short hedge behaves as you would. When you use yield, which is what you're really interested in, then the interest rates rise. You want to have a short. If you expect interest rates to fall, you want to take a long hedge. And so the extra cost of your funds, if in the case of rise, is offset by gains you make in the futures market. If you go the other way, then this one offset you here. So typically what you're concerned about is the interest rates rising and your funds costing you more, and that means you're naturally going to take a short hedge on this particular one. Okay, we're running out of time, so if you want to ask any questions, be around for a while. Otherwise, we'll see you tomorrow, and we'll start at that point there.
Oh really? But I don't know. I just did a rough calculation, but today because I have this pretty much I got. So, but anyway, just can you just hold it there? I'll go test it tonight.
Oh, yeah.
But tomorrow I'm gonna just check my numbers in the spreadsheet.
Right.
It'll be easier because I feel like it's something to do with if because I just gave you the total number.
Yeah.
So if I assume that if I separate from the the reinvest income as well as the the capital gain, I think it would be more clear. I'll just try to just do that in a spreadsheet to see how it goes.
Yeah.
Yeah. Thank you very much.
When you say close the account when you don't make when they couldn't make the margin calls, do you mean they just cancel the account so they can't trade anymore?
No, if there's money in there, say there was $500 in there, I mean, they don't take that. What they do is say the guy has a short position, what they'll do is to close it out, he's got to go long. Say he's got short position in 10 contracts. If they're going to close it out,